Hi, this is a comparative analysis of Home Depot and Lowe's done by Tim Lorenko and Ryan Porto. Both Home Depot and Lowe's have similar major stockholders, including JP Morgan Chase and Vanguard. Neither company has insiders as major holders. This makes it difficult to estimate confidence from insiders. That being said, both companies are held by large mutual funds as well as investment banks. Therefore, it is reasonable to believe that these banks and funds would not be such largely invested without having confidence in the future of both Home Depot and Lowe's. It is very difficult to decide from the list of major holders which is preferable, but because Goldman Sachs holds Lowe's, it is conceivable to believe that Lowe's may be better positioned to succeed due to Goldman's massive resources. The current debt ratio for Home Depot is 10.73% with a perpetual growth valuation at $100.57 billion and a cost of capital at 6.56%. Optimal debt ratio for Home Depot is 40%. Such a change would reduce the cost of capital to 6.14% while increasing the perpetual growth value of the firm to $109.975 billion. Conversely, this would increase the cost of equity and debt as risk is increased. However, it would still total to an overall decrease in cost. Lowe's currently has a much higher debt ratio than Home Depot. At 24.52%, Lowe's has a perpetual growth valuation of $44.148 billion and a weighted average cost of capital of 6.49%. Calculated optimum debt ratio for Lowe's would be at 60%, and this would decrease cost of capital to 6.1% and increase the perpetual growth value of the firm to $48.41 billion. This too would increase the cost of equity and debt, yet reach a net reduction in cost. Some advantages of debt for the firm include lower cost of capital due to tax savings, while cash flows to equity is not. It also would increase the firm value. Some disadvantages to debt include greater exposure to default risk. Both Home Depot and Lowe's are not heavily invested in future projects. Each company does have exclusive proprietary products as well as merchandise sold outside of the stores. Expansion into new locations is a larger demand for capital, which some investment from each firm. Going into product development in 2011, Home Depot spent slightly over $1.1 billion on store and location expansion while spending a little more than $33 million on development. Lowe's has taken on greater projects totaling over $1.8 billion on store expansion and over $450 million on development. The estimation for pre-tax cost of debt financing is found by adding the default spread relative to each company to the risk-free rate of 2%. The default spread for Home Depot and Lowe's is 1.65%, which is derived from applying the Standard & Poor's credit rating to the default table for large manufacturing firms. The table was provided by Professor DeModeron of the Leonard School of Business at New York University. Both companies have a credit rating of A-, and therefore the spread equates to 1.65%. This brings the pre-tax cost of debt to 3.65% for both Lowe's and Home Depot. Home Depot has a slightly higher effective tax rate than Lowe's, therefore they receive a larger benefit from debt financing. The effective tax rate for Home Depot and Lowe's is 37% and 36.7% respectively. Home Depot's 5-year monthly stock returns versus market returns regression slope resulted in a beta of 0.77. Home Depot performed 0.66% worse than CAPM would estimate based upon monthly averages from 2006 to 2011. Lowe's 5-year monthly stock returns versus market returns regression slope brought a beta of 0.99 and outperformed CAPM by 0.65%. Based on 3-year weekly regression from 2009 to 2011, Home Depot shares have experienced increased volatility with a mean beta of 1.039 and performed 0.56% worse than CAPM would estimate. Lowe's underperformed to CAPM as well by 0.46% and carried a mean beta of 1.044%. Using the derived information from the financials on Yahoo Finance, this shows the weighted average cost of capital for both Lowe's and Home Depot. This is the optimal structure for Home Depot based on Professor DeModeron's provided spreadsheets. As one can see, an increase in debt would decrease the weighted average cost of capital and increase the overall value of the firm. These are the inputs used in order to calculate the optimal structure for Home Depot based upon the information gathered from Yahoo Finance. This is the optimal structure for Lowe's based on Professor DeModeron's provided spreadsheets. As one can see, an increase in debt would decrease the weighted average cost of capital and increase the overall value of the firm. These are the inputs used in order to calculate the optimal structure for Home Depot based upon the information gathered from Yahoo Finance. An increase in debt financing for both Home Depot and Lowe's would bring both firms closer to their optimum value. Home Depot has a debt equity ratio of 10.73%, yet analysis shows that the optimal level for debt to equity ratio is 40%. Bringing debt financing to this level would increase the value of the firm by $8.352 billion and lower their cost of capital to 6.05% from 6.55%. This, however, will increase the volatility of the stock and put the firm at a greater risk of default for bankruptcy. Lowe's optimum structure requires an even greater debt to equity ratio, as the optimal rate is 60%. An increase to this would increase the value of Lowe's by $5.728 billion and would decrease their cost of capital to 5.96% from 6.47%. Home Depot and Lowe's both have debt ratios considerably beneath their optimal levels. Therefore, theoretically, it would benefit both companies to take on more debt. An increase in debt will decrease each firm's cost of capital while increasing their perpetual growth value. However, some side effects to debt may increase the volatility of the company and increase their exposure to default risk. Debt carrying capacity is heavily industry related, yet the desire of management to set levels reflect their risk appetite. Some of the advantages of carrying more debt or operating at optimal debt ratio include tax savings. Interest expenses are tax deductible while cash flows to equity dividends are not. This benefit increases with the tax rate. Also, increase in the firm value. A few disadvantages of carrying more debt include the probability of default is greater for firms that have volatile cash flows. Also, higher expected bankruptcy costs and probability of default increases. Decrease in bond ratings and loss of flexibility. Both Lowe's and Home Depot minimize their use of debt as a means of decreasing volatility and exposure of default risk. In big box retail, margins are slowly decreasing as companies look to decrease costs. Higher debt increases bond interest rates. Also, in a recession economy, it is considered that both companies are fearful of future market conditions and therefore do not want to increase risk. For this reason, it seems as if both companies are trying to minimize their cost of debt in order. Two competitors that are public companies are Orchard Supply Hardware Stores and Tractor Supply Company. Both of the subject companies, Home Depot and Lowe's, have lower current liabilities than their competitors. Orchard Supply has the majority of their liabilities allocated as long-term and is the same way for their assets. Lowe's and Home Depot also allocate a large portion of their assets as long-term. The subject companies do carry a smaller amount of cash, but they make up for it in their other current assets. Tractor Supply Company is very heavy in other current assets, and they carry more cash than both of the subject companies. Orchard Supply's debt-to-equity ratio has a very high amount of long-term debt in comparison to their stockholders' equity. Their ratio is 306%. They also have high total liabilities to total asset ratio. That ratio is 84.25% and is larger than both of the subject companies. Tractor Supply has a high current liabilities and are very light in the area of long-term liabilities, helping the debt-to-equity ratio at 7.9%. This is a graph of cash, other current assets, and long-term assets as a percentage of total assets as seen on previous table. This is a graph of current liabilities, long-term liabilities, and shareholders' equity as a percent of total liabilities and equity, also derived from the previous table. This is a debt-to-equity graph derived from the numbers below. Lowe's most recent stock price is $29.18 per share. The first analysis that was performed is a basic tool used to analyze the stock price when you factor earnings per share with the price to equity ratio. Lowe's has earnings per share of $21.16 and a price to equity ratio of 2.68. This gives you the valuation of $29.14 per share. Home Depot is currently priced at $58.86 in the market. Based off of earnings per share and the price to earnings ratio, the price of the stock is $56.71. Secondly, both the companies pay dividends. The dividend growth model is commonly used to evaluate a company who pays dividends. The formula is the company dividend times the growth rate plus 1 divided by the required rate of return minus the growth rate. Lowe's pays a dividend of 64 cents per share annually with a growth rate of 2.19%. The price per share based off of the dividend growth model for Lowe's is $23.27. Based off the dividend growth model, the price of the stock for Home Depot is calculated to be $39.04. Using analyst estimates for forward EPS and forward PE, the 12-month price of Home Depot and Lowe's shares are as follows. Home Depot's price is $67.03, while Lowe's is $36.15. And this is the conclusion of the presentation. Thank you.